At the start of a new calendar year, I think it's always appropriate to just look back at what has happened in the previous year. And when I look back at what has happened in 2020, I thought it was quite appropriate to think about the words of a legend Springbok rugby player, a man called Umboy Low. So Umboy Low used to say, whenever it was a tight call, just looks at the scoreboard. And it's amazing if we think about what we went through from an economic and from a human perspective in 2020, that the South African equity market still managed to close 7% in the blue. In other words, South African equities on average went up by 7%. But even if you look at the global markets, the performance was materially good, where emerging markets ended the year up by more than 18%, and developed markets on average ended the year up by about 17%. And then, of course, we've seen astounding performance from IT shares in the world, and as measured by the Nasdaq index, those shares on average went up by 47% in a year where we were plagued with negative economic growth and a pandemic that you have to go back for a century to see these kind of circumstances. So one can probably ask, why did the markets perform that well? And I think the markets were quite rational, if you want to say that, because the market looked through the pandemic and look at the conditions as they would expect them to continue going into the future. That might be one explanation. But there was also another explanation. And I think there's certainly part of truth in that, and that there was a bit of exuberant irrationality in the way that markets acted. So in short, we think that the markets overreacted, were a bit too positive, and that of course must have an impact on the prospective returns if you look forward. Nevertheless, the returns were recorded, and when clients look at their statements, they would see that they've got more money at the end of 2020 than at the beginning of 2020. And given the circumstances, I guess that is quite a decent outcome. So how did the macro conditions change? The fact that the calendar moved from 2020 to 21 didn't really make a lot of change. But I think it is important to note a few things. The first change is, at least we don't have to comment about Donald Trump anymore. Secondly, we don't have to comment about Brexit anymore. Trump is history and Brexit is history. But I think it's important just to highlight one or two factors when we talk about the macro environment. Firstly, back in 2020, with the exception of China, which recorded a positive growth rate of 2.3%, the rest of the world recorded negative growth rates. In other words, the size of the global economy shrunk during 2020. However, when we look at the response by economic authorities to the hardship that the economies faced, there's just one comment to make, and that is they've brought the punch bowl to the economy. In other words, they've tried to stimulate the economy both from a monetary perspective. In other words, interest rates fell to very, very unprecedented low levels. And secondly, we've also seen that the fiscal response, in other words, the way that governments spent money, was very expansionary. And that helped the recovery in economic activity and certainly boosted the momentum in the economic recovery during the third and fourth quarter of last year. We expect more of the same for 2021. So where last year on average global growth was about minus 4.5%, this year one would expect the global growth to be at a level of about 4% on average. And again, if we look at the second biggest economy in the world, the economy of China, we reckon that economy can grow at a rate of between 7 and 8% should nothing derail the current momentum in that economy. So the outlook is still pretty decent. Secondly, and that matters to financial markets, is what is the price of money? And what we have experienced so far is that the economic authorities up until now hasn't given any indication that they will take their foot off the accelerator. In other words, they will continue to stimulate because they don't want to risk a slowdown in economic momentum in the world. Of course, what is very important for financial markets is the fact that the stimulus measure, namely creating liquidity to boost economic activity, also leads to a lot of liquidity looking for a home or a haven. And what we've experienced is that that liquidity has undoubtedly boosted the demand for risky assets. That was part of the reason why we think that Nasdaq has performed exceptionally well last year. And as part of the reason why we've seen in certain sectors, we can talk about the prices of those sectors becoming very overheated. And in fact, in some cases, you can talk about bubbles, where in individual cases, some shares are simply trading at valuations that are not remotely related to the intrinsic value that we associate with them. But that is a factor that we need to deal with. What is the risk out of all this? Just ignore investment markets or financial markets for a while. The big risk is that to create the liquidity, governments have created heaps and heaps of debt. And at some point, you need to address the debt. At the moment, with South Africa as an exception, we can get away with it because interest rates are very low, so it's very cheap to fund the debt. At some point, investors will recognize that the debt becomes a risk and they would like to pay an appropriate price. In other words, they would like to get a higher price for the debt that they provide, and that will not be good for the world economy and will not be good for financial markets. If we can just turn for a moment to South Africa. South Africa has followed more or less the same path, really a big slowdown in economic activity last year, and we saw the momentum picking up in the third and the fourth quarter. From a very low base, we would expect the South African economy to grow in the region of about 4%. Having said that, the second wave of the pandemic, of course, would limit the mobility of economic activity in South Africa, and that introduces the risk that we might undershoot the 4% level. But nevertheless, the momentum will be up, but we must warn that it is a cyclical momentum. So where does it leave us with financial markets? The starting point for us always is valuation. So if you look at the valuation of global equities, the valuation is certainly elevated in terms of its own history. But when we invest, one must always remember that there are many alternatives. We can invest in fixed interest equities, property, and of course a number of unconventional assets. When we compare the valuation of equities with that of fixed interest investments globally, we still think that on a relative basis, equities are more attractive because the yields of long-term government bonds are simply exceptionally low. So on a relative basis, we would prefer global equities to global bonds. They are still decent enough companies, and it's a very important point to make. Decent enough companies with low enough valuations that we can acquire for client portfolios. A lot of the froth that we spoke about, or the expensive shares, are very concentrated, either in smaller companies with a fantastic growth story, or in the 5 major cap companies that are slightly elevated. But there's another section or universe where we can certainly find value. If we turn to South Africa, government bonds do appear quite attractive. The 10-year bonds trade at a yield of about 9%. If you work with inflation of 5%, it means that you still can get a 4% real yield for a 10-year investment. However, the fiscal situation in South Africa is going from bad to worse. And at some point, we've got to take the fiscal risk into consideration when we invest in these assets. And therefore, my view is that we are likely to reduce the exposure to that asset class despite the apparent attractiveness relative to inflation rate. Let's talk about equities. The South African market is a very diverse market. We've got rand hedges, good global companies listed on our stock exchange. And then on the other end of the spectrum, we've got decent companies, but they make their money in South Africa. As long as the macro story is still one where economic growth is subpar, then one must understand it will remain a tough environment for these companies to make decent profits. However, we think that the latter view that I've explained is baked into the valuations of those companies. So if you look at the valuation of the South African equity market on a forward basis, 12.5 times. That is cheap in terms of its own history. It's cheap relative to other assets, but it's got a story associated that is less favorable than offshore assets. Yet, in a multi-asset portfolio, we would favor that asset class. Looking further ahead, I think it's also important to note that we've seen a significant strengthening in the currency. We still think that some of our clients are not properly geographically diversified, and therefore with a stronger currency, we think that those clients should consider migrating a bigger proportion of their assets offshore, given these risks that we've spoken about. Despite the fact that the indices look to be trading at an elevated level, there's still enough decent assets that we can acquire overseas that promises good prospective returns. To summarize, the starting point of markets are slightly more elevated. However, the economic momentum is behind most of the economies. Authorities are trying their best to provide enough stimulus to maintain that momentum. But as we know, when we look forward, there's always an amount of uncertainty around. And with interference from governments, that uncertainty increases. Yet from longer term perspective, there's no way around it that clients cannot afford to reduce risk and then expect to outperform inflation both internationally and locally. So now is the time for active management and not panicking out of risky assets.